Imagine if three companies quietly own pieces of almost every big company on Earth. Not countries, not governments, just three firms. They don't make phones, they don't sell food, they don't build cars, but they own parts of the companies that do. Today we're going to talk about BlackRock, Vanguard, and State Street, and how they ended up with enormous power over the global economy. And don't worry, we're going to explain this slowly, simply, and clearly. You may have heard these names before: BlackRock, Vanguard, State Street. Most people think they're banks. They're not. They are asset managers. That means they don't usually invest their own money. Instead, they manage other people's money. Retirement savings, pension funds, insurance money, government funds, regular people investing for the future. Think of them like giant money caretakers. Millions of people hand them money and say, "Please invest this for me." And these firms decide where that money goes. Let's use a simple example. Imagine a giant basket that holds many companies at once. Instead of picking just one company, you buy the whole basket. That basket is called an index fund. BlackRock, Vanguard, and State Street became powerful by creating and managing these baskets. Why did people love them? They were cheap, they were simple, they spread risk, so millions of people around the world poured their money into them. Slowly, quietly. These three firms started buying small pieces of everything: Apple, Google, Amazon, banks, airlines, energy companies. Not one company, almost all of them. Here's where it gets interesting. If you own even a small piece of a company, you get voting rights. Voting rights mean voting on board members, voting on company policies, voting on executive pay, voting on long-term strategy. Now imagine this: BlackRock, Vanguard, and State Street don't just own shares in one company. They own shares in competing companies. They own parts of all major banks, all major airlines, all major tech firms. This is called common ownership, and it creates a strange situation. If one investor owns pieces of all competitors, what happens? Competition can soften. Why fight aggressively with your competitor if your biggest shareholder owns both of you? This doesn't require a secret meeting. No phone calls, no conspiracy. It's just incentives. Companies start acting safer, not necessarily better. Prices may stay higher. Innovation may slow. Risk-taking becomes less attractive, not because someone said so, but because the system nudges it that way. You might be thinking, they don't run the companies, so what's the problem? True, they don't manage day-to-day operations. But they have something more powerful than control. They have influence. When these firms speak, companies listen. Why? Because losing their support can mean falling stock prices, board trouble, investor panic, so even quiet suggestions matter. This is called soft power, and soft power is often more effective than direct control. Let's bring this down to everyday life. Your retirement savings, probably invested through one of them. Your pension fund, likely managed by one of them. Your country's stock market, influenced by their decisions. That means where money flows, which industries grow, which industries shrink, isn't decided by millions of individuals anymore. It's decided by how these funds allocate capital, slowly, systematically, at massive scale. Now, to be fair, there are benefits. During financial crises, these firms add stability, reduce panic, keep markets functioning. During COVID, they help prevent total collapse. But there's a trade-off. Too much stability can mean fewer bold ideas, less competition, safer, slower progress. Innovation thrives on risk. Large systems avoid risk. Their influence doesn't stop at companies. It reaches governments too. When massive funds move money, governments notice regulators respond, policies adapt. Not because anyone is bribed, not because laws are broken, but because money talks. This blurs the line between private investment, public decision-making, and raises a simple question. Who is the economy really designed to serve? Here's the honest answer. It's both. These firms make investing easier, lower costs for millions, stabilize markets, but they also concentrate power, reduce competition, shape outcomes quietly. This isn't about villains, it's about systems. Systems don't need bad intentions, they just follow incentives. BlackRock, Vanguard, and State Street didn't take power. The system gave it to them. Because people wanted simplicity, low fees, safety, and the system rewarded scale. This is what monetary mechanics is about. Not blaming individuals, not shouting politics, but understanding how money flows, how power accumulates, and how systems shape outcomes. So next time you hear these names, remember, they don't rule the world, but they quietly shape it, and understanding that is the first step toward understanding how the modern economy actually works. If you made it this far, I'd love to hear your thoughts on the influence of these corporations. Do you think their power is a good thing, or does it pose risks to the economy and society? Let me know in the comments. Check out my other videos for more insights into what really shapes our society.